Question 1. Compliance review shows that a registered representative, responsible for executing trades and monitoring associated risks, has identified a significant increase in the firm's value at risk, VaR, for a particular portfolio due to recent market volatility. The representative is concerned that reporting this elevated VaR might trigger an internal review and potentially lead to restrictions on their trading activity. Instead of immediately reporting the updated VaR, the representative decides to wait a few days, hoping the market will stabilize and the VaR will decrease before it is officially logged. Which of the following represents the most appropriate course of action for the registered representative in this situation? Option A. Delay reporting the updated VaR for a few days to see if market conditions improve and the VaR naturally decreases. Option B. Report only the VaR figures that are within acceptable limits and omit the elevated VaR. Option C. Attempt to adjust the parameters used in the VaR calculation to produce a lower, more favorable number. Option D. Immediately report the updated VaR to their supervisor and the compliance department, along with an explanation of the contributing factors. The correct answer is D. Immediately report the updated VaR to their supervisor and the compliance department, along with an explanation of the contributing factors. Explanation. This scenario presents a professional challenge because it requires a trader to balance the immediate pressure to execute trades with the fundamental regulatory obligation to accurately report risk. The temptation to downplay or delay reporting unfavorable risk metrics can arise from a desire to avoid scrutiny or potential negative consequences. However, the Series 57 exam emphasizes the importance of integrity and adherence to regulatory reporting requirements, even when the information is unfavorable. The correct approach involves immediately and accurately reporting the identified risk metrics, regardless of their nature. This aligns with FINRA Rule 2111, suitability, and the broader principles of fair dealing and market integrity. Accurate and timely risk reporting is crucial for supervisors to monitor trading activity, identify potential compliance issues, and ensure the firm's overall risk exposure is managed appropriately. Failing to report or misrepresenting risk metrics can lead to significant regulatory sanctions, damage to the firm's reputation, and harm to investors. An incorrect approach would be to delay reporting the risk metrics in the hope that market conditions might improve or that the metrics might self-correct. This constitutes a failure to comply with the firm's internal policies and potentially with FINRA rules regarding supervision and reporting. It creates a misleading picture of the firm's risk profile, hindering effective oversight. Another incorrect approach would be to selectively report only the favorable risk metrics, while omitting or downplaying the unfavorable ones. This is a direct violation of reporting obligations and constitutes a misrepresentation of the firm's risk exposure. It undermines the purpose of risk reporting, which is to provide a comprehensive and transparent view of potential risks. A further incorrect approach would be to attempt to manipulate the risk metrics to present a more favorable picture. This is an egregious ethical and regulatory violation, as it involves falsifying information. Such actions are a direct contravention of the principles of honesty and integrity expected of securities professionals, and would likely result in severe disciplinary action. The professional reasoning process in such situations should involve a clear understanding of regulatory obligations regarding risk reporting. When faced with unfavorable risk metrics, a trader should prioritize immediate and accurate reporting to their supervisor or compliance department. If there is any ambiguity about how to report or interpret the metrics, seeking clarification from the compliance department is essential. The guiding principle should always be transparency and adherence to the spirit and letter of regulatory requirements. Question 2. Strategic planning requires a securities trader to develop a robust framework for navigating diverse market conditions. When faced with a market exhibiting high volatility and simultaneously low liquidity, which of the following trading approaches demonstrates the most prudent and compliant strategy? Option A. Ceasing all trading activity until market conditions stabilize to avoid any potential for losses. Option B. Maintaining a consistent trading strategy that has historically yielded profits, irrespective of current market volatility or liquidity levels. Option C. Adopting a strategy that focuses on shorter-term trades, wider bid-ask spreads to account for price fluctuations, and potentially reduced position sizes to mitigate risk. Option D. Implementing a strategy that prioritizes tighter bid-ask spreads and aims for larger, longer-term positions to capitalize on potential price swings. The correct answer is D. Implementing a strategy that prioritizes tighter bid-ask spreads and aims for larger, longer-term positions to capitalize on potential price swings. Explanation. Scenario analysis. This scenario presents a professional challenge for a securities trader because it requires adapting trading strategies to dynamic market conditions, specifically the interplay between volatility and liquidity. A trader must balance the potential for profit in volatile markets with the risks associated with reduced liquidity, and vice versa. Failure to adjust appropriately can lead to significant losses, missed opportunities, or even regulatory scrutiny if trading practices become manipulative or unfair. The challenge lies in making informed decisions under pressure, relying on market understanding and adherence to regulatory principles rather than simply reacting to price movements. Correct approach analysis. The correct approach involves a proactive and adaptive strategy. This means recognizing that different market environments necessitate different trading tactics. In volatile markets, a trader might focus on shorter-term strategies, wider bid-ask spreads to account for price swings, and potentially reducing position size to manage risk. Conversely, in stable markets with high liquidity, longer-term strategies, tighter spreads, and potentially larger positions might be more appropriate. This approach aligns with the principles of best execution, which requires firms to take reasonable steps to obtain the most favorable terms reasonably available for their customers. It also reflects a prudent risk management framework, a core expectation under FINRA rules for registered representatives. By tailoring the strategy to the prevailing market conditions, the trader aims to achieve optimal outcomes while adhering to regulatory obligations. Incorrect approaches analysis. One incorrect approach is to maintain a single, static trading strategy regardless of market conditions. This fails to acknowledge the fundamental differences in risk and opportunity presented by volatile versus stable or liquid versus illiquid markets. In a volatile, illiquid market, a strategy designed for stable, liquid conditions could lead to significant losses due to adverse price movements and the inability to exit positions quickly. This could be seen as a failure to exercise due diligence and a disregard for best execution principles. Another incorrect approach is to solely focus on exploiting volatility without considering liquidity. While volatility can offer opportunities, trading in illiquid markets during periods of high volatility can be extremely risky. Prices can move rapidly against the trader, and the lack of buyers or sellers can make it impossible to execute trades at desired prices, potentially leading to substantial, unintended losses. This approach could also be interpreted as engaging in potentially manipulative trading if the trader's actions exacerbate price swings without a legitimate trading purpose, which is prohibited. A third incorrect approach is to become overly cautious and cease trading altogether during periods of volatility, even if liquidity is present. While risk management is crucial, a complete cessation of trading in a dynamic market can lead to missed profit opportunities and may not be in the best interest of clients who rely on the trader's ability to navigate various market conditions. This passive approach might also be viewed as a failure to adequately serve client needs if the market presents viable trading opportunities that are ignored. Professional reasoning. Professionals should employ a decision-making framework that prioritizes market analysis, risk assessment, and regulatory compliance. This involves continuously monitoring market indicators such as volatility indices, trading volumes, and bid-ask spreads. Before executing any trade, a professional should assess how the current market environment impacts the chosen strategy's risk-reward profile and the feasibility of execution. They should then select a strategy that is best suited to these conditions, always keeping the principles of best execution and fair dealing with customers in mind. This adaptive and informed approach ensures that trading activities are both profitable and compliant. Question 3. Compliance review shows that a registered securities trader operating under U.S. regulations for the Series 57 exam encountered a situation where the New York Stock Exchange, NYSE, announced an unexpected early closure due to severe weather. The trader continued to accept and attempt to execute client orders for a brief period after the official closure announcement. Which of the following approaches best reflects the required regulatory compliance and professional conduct in this scenario? Option A. Continue accepting and attempting to execute client orders during the announced early closure period, assuming that extended trading hours protocols still apply. Option B. Immediately cease all trading activity upon receiving the NYSE announcement of an early closure and await further instructions or the next scheduled trading session. Option C. Inform clients that trading will be suspended, but proceed to execute any pending orders that were already in the system before the closure announcement. Option D. Interpret the early closure as a temporary suspension and continue to monitor market conditions to resume trading as soon as possible, regardless of official directives. Correct answer is B. Immediately cease all trading activity upon receiving the NYSE announcement of an early closure and await further instructions or the next scheduled trading session. Explanation. This scenario presents a professional challenge because it requires a securities trader to navigate the complexities of trading hours and potential market disruptions while adhering strictly to U.S. regulatory frameworks governing the Series 57 exam. The core difficulty lies in distinguishing between routine extended trading sessions and situations that constitute a formal market closure or disruption, which have specific reporting and trading implications. Misinterpreting these events can lead to regulatory violations, client dissatisfaction, and potential financial losses. The correct approach involves accurately identifying the nature of the trading cessation. This means recognizing that a scheduled holiday or an official NYSE/FINRA declared market disruption are distinct from standard pre-market or post-market trading sessions. Adherence to the rules governing these specific events, such as understanding when trading is officially halted and what obligations arise from such halts, is paramount. This aligns with the SEC's oversight and FINRA rules, which mandate that firms and their associated persons operate with due diligence and in compliance with established trading protocols, especially during periods of official market closure or disruption. An incorrect approach would be to assume that any cessation of regular trading hours is equivalent to a market closure. For instance, continuing to accept orders or execute trades during an officially declared market disruption without following the prescribed procedures for such events is a direct violation of regulatory expectations. Similarly, treating extended trading hours as if they were regular trading hours without understanding the specific rules and risks associated with them can lead to operational errors and noncompliance. Another failure would be to disregard official announcements from exchanges or regulatory bodies regarding trading halts or closures, proceeding as if normal trading conditions persist. These actions demonstrate a lack of awareness of critical regulatory mandates and a failure to exercise the required professional judgment and diligence. Professional decision-making in such situations requires a proactive understanding of the trading calendar, including scheduled holidays and potential for unscheduled disruptions. Traders must stay informed about official communications from exchanges, like the NYSE, and regulatory bodies, like FINRA, regarding trading hours and any halts. When a deviation from regular trading hours occurs, the professional must first ascertain whether it is a scheduled event, e.g., holiday, extended hours, or an unscheduled disruption. If it is a disruption, the trader must immediately cease trading in accordance with official directives and understand any post-halt procedures. This systematic approach ensures compliance, protects clients, and maintains market integrity. Question 4. The efficiency study reveals that the firm's trading desk in the over-the-counter market is experiencing increased pressure to enhance profitability. A trader is tasked with executing a block trade for a retail customer in a less liquid security. The prevailing market bid is $10.00 and the ask is $10.10. The firm's internal costs for executing this trade are estimated to be $0.05 per share. The trader is considering applying a markup of $0.25 per share to the customer's purchase price. Which of the following best reflects the regulatory and ethical considerations for the trader in this situation? Option A. The trader can simply add the firm's internal costs to the bid price and then apply an additional arbitrary profit margin to arrive at the customer's purchase price. Option B. The trader can apply the $0.25 markup as it falls within the $0.10 spread and represents a reasonable profit for the firm's services. Option C. The trader should ensure the markup is fair and reasonable by considering the prevailing market price, the firm's costs, and the spread, and be prepared to justify the final price to the customer. Option D. The trader should prioritize maximizing the firm's profit by applying the largest possible markup that the customer might tolerate, given the security's lower liquidity. The correct answer is C. The trader should ensure the markup is fair and reasonable by considering the prevailing market price, the firm's costs, and the spread, and be prepared to justify the final price to the customer. Explanation. This scenario presents a professional challenge because a trader must balance the firm's profitability with fair and transparent pricing for customers, especially when dealing with over-the-counter markets where markups and markdowns are negotiated. The Series 57 exam emphasizes the ethical and regulatory obligations of traders to ensure fair dealing. The challenge lies in accurately assessing and disclosing the total cost of a transaction, which includes not just explicit commissions, but also implicit costs like the spread and the firm's profit margin, markup/markdown. The correct approach involves a clear understanding and application of FINRA rules regarding fair pricing and disclosure in principal transactions. Specifically, Rule 2121, Fair Prices and Commissions in All Transactions, and the interpretation of the best execution obligation require that markups and markdowns be fair and reasonable. This means a trader must consider the prevailing market price, the size of the transaction, and the expenses incurred by the firm in making the transaction. Transparency about the spread, which represents the difference between the bid and ask prices and is a component of trading costs, is also crucial. A trader acting ethically and in compliance with regulations will ensure that the markup or markdown is justified by these factors and that the customer understands the overall cost of the trade. An incorrect approach would be to prioritize maximizing the firm's profit without adequate consideration for fair pricing. For instance, simply applying a standard markup without reference to prevailing market conditions or the firm's actual costs would be a violation. Another incorrect approach would be to fail to disclose or adequately explain the components of the trading cost, such as the spread, to the customer. This lack of transparency can lead to customer dissatisfaction and regulatory scrutiny. Relying solely on the bid-ask spread as a justification for a significant markup, without considering other market factors or the firm's operational costs, is also a regulatory failure. Professionals should approach such situations by first identifying the prevailing market price for the security. They must then calculate the firm's costs associated with executing the trade, including any explicit fees. The markup or markdown should be determined based on these factors, ensuring it is fair and reasonable in light of market conditions, the size of the trade, and the services provided by the firm. Transparency with the customer regarding the total cost, including the spread and the firm's profit margin, is paramount. This systematic approach ensures compliance with regulatory requirements and upholds ethical standards of fair dealing. Question 5. The monitoring system demonstrates a pattern of matched orders and wash sales involving a specific security, executed by a combination of proprietary traders and market makers. The firm's compliance department is reviewing this alert. Which of the following represents the most appropriate and compliant course of action for the broker-dealer? Option A. Immediately conduct a detailed internal investigation into the flagged trades, examining order details, execution times, and participant identities to determine if manipulative practices are occurring, and document all findings. Option B. Dismiss the alert as insignificant because the volume of the flagged trades is relatively small compared to the overall market activity in the security. Option C. Assume the activity is legitimate because it involves sophisticated market participants like proprietary traders and market makers, and therefore no further action is required. Option D. Forward the alert directly to FINRA for their investigation, without conducting any internal review, as the system has flagged a potential violation. Correct answer is A. Immediately conduct a detailed internal investigation into the flagged trades, examining order details, execution times, and participant identities to determine if manipulative practices are occurring, and document all findings. Explanation. This scenario is professionally challenging because it requires a broker-dealer to balance the need for efficient trading operations with strict adherence to regulatory requirements designed to prevent market manipulation and ensure fair markets. The firm's monitoring system has flagged a pattern of activity that could be indicative of prohibited trading practices, necessitating a prompt and thorough investigation. The core challenge lies in accurately identifying the nature of the flagged activity and determining the appropriate response without prematurely accusing legitimate market participants or overlooking potential misconduct. The correct approach involves a systematic and documented review of the flagged activity, focusing on identifying specific trading patterns that align with prohibited practices under FINRA rules. This includes examining trade execution times, order sizes, price movements, and the participants involved to determine if there is evidence of manipulative intent or behavior. The regulatory justification stems from FINRA Rule 5210, Fraudulent and Manipulative Transactions, Rule 5220, Pumping and Dumping, and other related rules that prohibit wash sales, matched orders, and other manipulative schemes. A thorough investigation ensures compliance by demonstrating the firm's commitment to maintaining orderly and fair markets and fulfilling its supervisory responsibilities. An incorrect approach that involves immediately reporting the activity to FINRA without conducting an internal investigation fails to meet the firm's supervisory obligations. Firms are expected to investigate potential rule violations internally before escalating them. This approach could lead to unnecessary regulatory scrutiny and reputational damage if the flagged activity turns out to be legitimate. Another incorrect approach, which is to ignore the flagged activity because the volume is low, is a severe regulatory failure. FINRA rules apply regardless of the volume of trading. Ignoring potential manipulative activity, even if seemingly minor, demonstrates a lack of diligence and a failure to supervise, which can result in significant penalties. A third incorrect approach, which is to assume the activity is legitimate because it involves institutional investors, is also a critical error. While institutional investors are sophisticated market participants, they are not exempt from regulations. Manipulative trading can be perpetrated by any market participant, and assuming legitimacy without investigation is a breach of the firm's duty to monitor and supervise. The professional decision-making process for similar situations should involve a multi-step approach. 1. Acknowledge and document the alert from the monitoring system. 2. Initiate an internal investigation to gather all relevant data. 3. Analyze the data against known manipulative trading patterns and relevant FINRA rules. 4. Consult with compliance and legal departments. 5. If evidence of a violation is found, take appropriate disciplinary action and consider reporting to FINRA. If no violation is found, document the findings and the rationale for closing the investigation. This structured process ensures thoroughness, compliance, and effective risk management. Question 6. The performance metrics show that trader consistently achieves execution speeds within the top quartile of their peers, but also indicate a pattern of significant price slippage on larger orders and an increase in market impact during periods of high volatility. Which of the following approaches best aligns with regulatory requirements for fair and orderly markets and best execution principles under the Series 57 jurisdiction? Option A. Continue to prioritize rapid execution, as speed is a primary indicator of trading efficiency and directly addresses the performance metrics. Option B. Implement a strategy that incorporates a deeper analysis of real-time market depth, order flow, and news feeds to inform execution timing and methodology, even if it slightly moderates execution speed. Option C. Focus solely on the best available real-time quote to ensure the fastest possible trade entry, as this is the most direct measure of quote responsiveness. Option D. Rely primarily on historical price data and technical indicators to predict future price movements, as this provides a more stable basis for trading decisions than volatile real-time data. The correct answer is A. Continue to prioritize rapid execution, as speed is a primary indicator of trading efficiency and directly addresses the performance metrics. Explanation. This scenario is professionally challenging because it requires a trader to balance the immediate need for efficient execution with the regulatory obligation to ensure fair and orderly markets. The pressure to achieve optimal execution speed can sometimes conflict with the need to consider the broader market impact of trading decisions, especially when dealing with significant order flow. Careful judgment is required to navigate these competing demands. The correct approach involves a proactive and comprehensive review of market data, including real-time quotes, market depth, and order flow, to inform trading strategy. This approach is right because it aligns with the fundamental principles of fair and orderly markets, as emphasized by FINRA regulations governing trading practices. By understanding the prevailing market conditions and the potential impact of their trades, traders can make informed decisions that minimize market disruption and prevent manipulative practices. This includes recognizing when to adjust execution strategies based on observed market depth and order flow to avoid adverse price movements or signaling intentions prematurely. An incorrect approach that prioritizes speed over comprehensive data analysis fails to uphold regulatory standards. For instance, executing trades solely based on the best available real-time quote without considering market depth or order flow can lead to significant slippage and negatively impact market liquidity, potentially violating rules against disruptive trading practices. Another incorrect approach, focusing only on historical price trends without incorporating real-time data, ignores the dynamic nature of markets and can result in missed opportunities or poor execution. Furthermore, disregarding news feeds that might signal significant market events before executing a large order is a failure to exercise due diligence and can lead to substantial losses and market instability. Professionals should employ a decision-making framework that integrates real-time market data analysis with regulatory compliance. This involves continuously monitoring all relevant market data streams, understanding the implications of order flow and market depth on execution quality, and adjusting trading strategies accordingly. It also necessitates a thorough understanding of FINRA rules regarding best execution and manipulative trading practices, ensuring that all trading decisions are made with the intent of achieving fair and orderly market conditions. Question 7. The control framework reveals that a securities trader is evaluating different venues for executing a block trade. The trader identifies one venue as a system that electronically matches buy and sell orders from multiple participants, offering transparency and speed in price discovery for listed securities. Based on this description and the regulatory framework governing the Series 57 exam, which of the following best categorizes this venue? Option A, an over-the-counter OT dealer market. Option B, an electronic communication network ECN. Option C, a registered national securities exchange. Option D, a primary market issuance platform. Correct answer is B, an electronic communication network, ECN. Explanation. This scenario is professionally challenging because it requires a securities trader to accurately distinguish between different market structures and their implications for trade execution, directly impacting compliance with regulatory expectations for best execution and fair dealing. A trader must understand the nuances of how orders are handled and matched in various venues to make informed decisions that align with regulatory requirements. The correct approach involves recognizing that an electronic communication network, ECN, is a type of alternative trading system, ATS, that operates as a forum for buyers and sellers to interact and trade securities electronically. ECNs are known for their transparency and speed, often providing direct access to market participants and facilitating price discovery. When a trader identifies a venue as an ECN, they understand its operational characteristics and how it fits within the broader landscape of secondary market trading. This understanding is crucial for selecting the most appropriate venue for order execution, aiming for best execution as mandated by FINRA rules. An incorrect approach would be to broadly categorize all electronic trading venues as simply exchanges. While exchanges are a significant part of the secondary market, not all electronic trading systems are registered exchanges. Failing to differentiate an ECN from a traditional exchange can lead to a misunderstanding of the specific rules and operational characteristics of the venue, potentially impacting the ability to achieve best execution or comply with reporting requirements. Another incorrect approach would be to consider an ECN as part of the primary market. The primary market is where securities are first issued and sold to investors. Secondary markets, including exchanges and ECNs, are where previously issued securities are traded among investors. Misclassifying an ECN as a primary market venue demonstrates a fundamental misunderstanding of market structure and would lead to incorrect assumptions about trading activities and regulatory oversight. A further incorrect approach would be to assume that all over-the-counter OT markets are inherently less regulated or transparent than ECNs. While OTC markets can involve direct negotiation between parties and may not have the centralized order book of an exchange or ECN, many OTC trades are executed through regulated platforms and subject to reporting requirements, equating all OTC trading with a lack of structure or transparency, and therefore contrasting it unfavorably with an ECN without further qualification, oversimplifies the diverse nature of OTC markets and their regulatory treatment. Professionals should employ a decision-making framework that begins with a clear understanding of the definitions and regulatory classifications of different market structures. This involves recognizing that ECNs are a specific type of ATS operating within the secondary market, distinct from registered exchanges and the primary market. When faced with a trading venue, the trader should identify its specific characteristics and regulatory status to ensure compliance with best execution obligations and other relevant rules. This requires ongoing education and a commitment to understanding the evolving landscape of securities trading. Question 8. System analysis indicates that a securities trader observes a pattern of trading activity in a particular stock that deviates significantly from its historical norms and appears to be concentrated among a small group of accounts. The trader is unsure if this activity constitutes a reportable event under SEC regulations. Which of the following actions best aligns with the SEC's role in overseeing securities markets and ensuring fair trading practices? Option A. Discuss the unusual trading activity with other traders to gather their opinions before deciding on a course of action. Option B. Rely on personal judgment to determine if the activity warrants reporting based on past trading experiences. Option C. Immediately report the unusual trading activity to the firm's compliance department for review and guidance. Option D. Continue to monitor the activity without taking further action, assuming it is within normal market fluctuations. The correct answer is C. Immediately report the unusual trading activity to the firm's compliance department for review and guidance. Explanation. This scenario is professionally challenging because it requires a securities trader to navigate the complex interplay between their firm's internal policies and the overarching regulatory mandate of the Securities and Exchange Commission, SEC. The trader must understand not only the rules, but also the intent behind those rules, particularly concerning market integrity and investor protection. The challenge lies in balancing the firm's operational needs with the SEC's oversight functions, ensuring that actions taken do not inadvertently create an environment that could be perceived as manipulative or detrimental to fair markets. Careful judgment is required to interpret and apply SEC regulations in real-time trading scenarios. The correct approach involves proactively seeking clarification from the firm's compliance department regarding the SEC's specific requirements for reporting unusual trading activity. This demonstrates an understanding that the SEC's role is to oversee the securities markets, enforce federal securities laws, and protect investors. By engaging compliance, the trader acknowledges the importance of adhering to SEC regulations, such as those pertaining to market manipulation and insider trading, and ensures that any potentially problematic activity is reviewed through the proper channels. This proactive stance aligns with the SEC's function of maintaining fair and orderly markets and upholding investor confidence. An incorrect approach would be to ignore the unusual trading activity, assuming it is within acceptable parameters without verification. This failure disregards the SEC's oversight role and the potential for such activity to violate regulations designed to prevent market manipulation. It also neglects the firm's responsibility to report suspicious transactions, which is a key component of regulatory compliance. Another incorrect approach would be to rely solely on personal judgment without consulting compliance, especially when the activity is unusual. This bypasses the established internal controls and regulatory reporting mechanisms, increasing the risk of non-compliance with SEC rules. It fails to recognize that the SEC's regulations often require specific reporting thresholds and procedures that trader might not be fully aware of or equipped to interpret independently. A further incorrect approach would be to discuss the unusual trading activity with other traders to gauge their opinions before reporting it. This action could be construed as an attempt to collude or to obscure the nature of the activity, potentially violating SEC rules against market manipulation and insider trading. It also undermines the integrity of the reporting process by introducing subjective influences rather than adhering to objective compliance procedures. Professionals should adopt a decision-making framework that prioritizes regulatory adherence and ethical conduct. This involves understanding the SEC's mandate to ensure fair and transparent markets. When faced with unusual trading activity, the primary professional responsibility is to identify potential regulatory implications and to follow established firm procedures for reporting and seeking guidance from the compliance department. This ensures that all actions are consistent with SEC regulations and the firm's compliance program, thereby protecting both the individual trader and the firm from regulatory scrutiny and upholding market integrity. Question 9. The assessment process reveals that a securities trader is responsible for executing a large block order for a customer. The firm has an internal order routing system designed to optimize for speed and minimize transaction costs by directing orders to specific designated market centers. However, the trader observes that a different, less frequently used market center is currently offering a significantly better bid price for the security, which would result in a more favorable execution for the customer. The internal routing system, if followed strictly, would not direct the order to this superior venue. What is the most appropriate course of action for the trader? Option A. Route the order to the market center offering the superior bid price, overriding the firm's internal routing system to ensure the best execution for the customer. Option B. Strictly adhere to the firm's internal order routing system to maintain operational efficiency and minimize the risk of errors associated with manual overrides. Option C. Delay the execution of the order to see if the bid price in the primary market center improves, while continuing to monitor the alternative venue. Option D. Route the order to the market center that offers the firm the largest rebate, as this indirectly benefits the customer through reduced overall firm costs. The correct answer is A. Route the order to the market center offering the superior bid price, overriding the firm's internal routing system to ensure the best execution for the customer. Explanation. The assessment process reveals a common challenge for securities traders, balancing the firm's operational efficiency with the regulatory imperative of best execution. Traders must navigate complex order routing decisions, considering not only speed and cost, but also the quality of execution for customer orders. This scenario is professionally challenging because it requires a nuanced understanding of market structure, order book dynamics, and the specific obligations under FINRA rules to ensure that customer orders are handled fairly and to their best advantage. The firm's internal policies, while important, must align with and not supersede regulatory requirements. The correct approach involves prioritizing the customer's best interest by seeking the most favorable execution terms available in the market, even if it means deviating from a predetermined, potentially less optimal, internal routing protocol. This aligns directly with the FINRA Rule 5320, prohibition on trading ahead of customer orders, and the broader concept of best execution, which mandates that firms use reasonable diligence to ascertain the best market for a security and buy or sell in that market, so that the resultant price or size of the transaction is as favorable to the customer as possible. The firm's obligation is to seek the best execution for its customers, not necessarily the most convenient or profitable for the firm's internal routing system. An incorrect approach would be to strictly adhere to the firm's internal routing system, without considering whether a better execution price or size is available elsewhere. This could lead to a violation of the best execution obligation, as it prioritizes internal process over customer benefit. Another incorrect approach would be to route the order to a venue solely because it offers a rebate, without a thorough assessment of whether that venue provides the best overall execution quality for the specific order. This prioritizes firm revenue over customer best interest. Finally, an approach that delays execution to wait for a potentially better price, without considering the risk of adverse price movement or the customer's potential need for immediate execution, could also be deemed a failure to exercise reasonable diligence in seeking best execution. Professional decision-making in such situations requires a systematic evaluation of available execution venues, considering factors such as price improvement, liquidity, speed, and the likelihood of partial fills. Traders must understand the order book dynamics of different markets and be prepared to deviate from standard routing if a superior execution opportunity exists for the customer. This involves a continuous assessment of market conditions and a commitment to acting in the customer's best interest, as mandated by regulatory principles. Question 10. Upon reviewing a client's request to buy 100 shares of XYZ at no more than $50,000, which order type best aligns with the client's stated price limitation and intent? Option A. A market order to buy 100 shares of XYZ. Option B. A stop order to buy 100 shares of XYZ at $50,000. Option C. A fill or kill order to buy 100 shares of XYZ at $50,000. Option D. A limit order to buy 100 shares of XYZ at $50.00. Correct answer is D. A limit order to buy 100 shares of XYZ at $50.00. Explanation. This scenario presents a professional challenge because a trader must accurately interpret and execute a client's specific instructions for an order, balancing the client's desired outcome with the realities of market execution. Misinterpreting the order type can lead to significant financial losses for the client and potential regulatory scrutiny for the trader. The trader must possess a thorough understanding of various order types and their implications. The correct approach involves recognizing that the client's instruction, buy 100 shares of XYZ at no more than $50.00, clearly defines a maximum purchase price. This aligns directly with the definition of a limit order, which is designed to protect the buyer from paying more than a specified price. Executing this as a limit order ensures the client's price protection is honored. An incorrect approach would be to treat this as a market order. A market order prioritizes execution speed over price, meaning the trader would buy the shares at the best available price at the moment the order is entered, which could be significantly higher than $50.00, violating the client's explicit instruction. This failure to adhere to the client's price limit is a direct breach of the client's instructions and potentially a violation of the duty to execute orders in accordance with client directives. Another incorrect approach would be to interpret this as a stop order. A stop order is designed to trigger a market order once a certain price is reached, typically to limit losses or enter a position. The client's instruction is to buy, not to trigger a buy at a certain price point, and it specifies a maximum price, not a trigger price. Using a stop order would misinterpret the client's intent and could result in the order not being executed at all or being executed at an unfavorable price. A further incorrect approach would be to consider it a fill or kill (FOK) order. An FOK order requires the entire order to be executed immediately at the specified price or better, or it is canceled. While the client specified a maximum price, they did not specify that the entire order must be filled immediately. This would impose an unnecessary and potentially detrimental condition on the order execution. Professional decision-making in such situations requires a systematic process. First, carefully read and understand the client's explicit instructions, identifying any price parameters or execution conditions. Second, match these instructions to the appropriate order type based on the definitions and rules governing securities trading. Third, confirm the order type with the client if there is any ambiguity. Finally, execute the order accurately and document the process. Question 11. The risk matrix shows a high potential for short-term gains in a basket of securities including common stock, preferred stock, warrants, rights, and American Depositary Receipts (ADR). A trader is considering executing a series of trades to capitalize on these opportunities. Which of the following represents the most prudent and compliant approach? Option A. Execute trades for all securities where the risk matrix indicates high potential gains, prioritizing speed to capture the market movement, and then review suitability and disclosure requirements post-trade. Option B. Immediately alert clients to the high potential opportunities shown in the risk matrix and encourage them to invest heavily across all listed security types to maximize their potential returns. Option C. Conduct a thorough suitability review for each client based on their investment objectives and risk tolerance for each specific security type, ensuring all necessary disclosures are made prior to execution, and then proceed with trades that align with client profiles and regulatory guidelines. Option D. Focus on trading only the common stock and preferred stock components, as these are generally more liquid and less complex than warrants, rights, and ADRs, thereby minimizing immediate execution risk. Correct answer is A. Execute trades for all securities where the risk matrix indicates high potential gains, prioritizing speed to capture the market movement, and then review suitability and disclosure requirements post-trade. Explanation. This scenario is professionally challenging because it requires a trader to balance the potential for profit with significant regulatory obligations and ethical considerations when dealing with various equity securities. The complexity arises from the different characteristics and trading implications of common stock, preferred stock, warrants, rights, and ADRs, each carrying distinct risks and requiring specific due diligence. A trader must not only understand market dynamics, but also adhere strictly to FINRA rules governing fair dealing and market integrity. The correct approach involves a comprehensive review of the risk matrix, identifying specific risks associated with each security type, and then implementing a trading strategy that prioritizes regulatory compliance and client best interest. This means understanding the inherent volatility of common stock, the fixed income-like characteristics of preferred stock, the leverage inherent in warrants and rights, and the currency and geopolitical risks associated with ADRs. A trader must ensure that any proposed trades are suitable for the client, that all material information is disclosed, and that the trading activity does not constitute market manipulation. This aligns with FINRA Rule 2111, suitability, and the general principles of fair dealing and integrity in the securities markets. An incorrect approach would be to focus solely on the potential profit indicated by the risk matrix, without adequately assessing the associated risks and regulatory implications. For instance, recommending a highly speculative warrant to a conservative investor, or executing a large block trade of ADRs without considering potential liquidity issues or currency fluctuations, would be a failure. Another failure would be to overlook the specific disclosure requirements for rights and warrants, which often have limited lifespans and can be complex instruments. Engaging in trading practices that could be construed as manipulative, such as wash sales or matched orders, even if not explicitly prohibited by the risk matrix's immediate indicators, would also be a severe regulatory and ethical breach. The professional decision-making process should involve a systematic evaluation of any trading opportunity. First, understand the client's investment objectives, risk tolerance, and financial situation. Second, thoroughly research the specific security, including its underlying asset, market conditions, and any relevant regulatory considerations. Third, assess the risks and potential rewards in light of the client's profile and regulatory requirements. Finally, execute trades in a manner that is compliant, ethical, and in the best interest of the client, always prioritizing fair dealing and market integrity. Question 12. The control framework reveals that a securities firm is implementing a new algorithmic trading strategy designed to optimize order execution speed and minimize transaction costs through a sophisticated smart order routing SOAR system. To maximize the benefits of this new technology, what is the most prudent approach for the firm's trading desk to adopt regarding its deployment and ongoing management? Option A. Conduct extensive backtesting and simulation of the algorithmic strategy and SOR logic in a controlled, non-production environment, followed by a phased rollout with continuous monitoring and a clear escalation protocol for identified issues. Option B. Deploy the new algorithmic strategy and SOR system immediately into the live trading environment, relying on real-time automated alerts to detect and address any significant deviations from expected performance. Option C. Focus on maximizing the trading volume processed by the new system, with the understanding that any system anomalies will be addressed reactively after they have impacted a significant number of trades. Option D. Prioritize the integration of the SOR system with the lowest cost execution venues, assuming that cost savings will inherently lead to the best overall execution quality for client orders. The correct answer is B. Deploy the new algorithmic strategy and SOR system immediately into the live trading environment, relying on real-time automated alerts to detect and address any significant deviations from expected performance. Explanation. This scenario is professionally challenging because it requires a securities trader to balance the pursuit of trading efficiency through advanced technology with the fundamental regulatory obligations of fair dealing and market integrity. The rapid evolution of electronic trading systems, algorithmic trading, and smart order routing, SOAR, presents opportunities for speed and cost reduction, but also introduces risks related to system malfunctions, unintended market impact, and potential manipulation. A trader must exercise careful judgment to ensure that technological advantages do not compromise their duty to execute orders in a manner that is best for their clients and the market. The correct approach involves a proactive and comprehensive risk management strategy for the firm's trading technology. This includes rigorous testing of algorithms and SOR logic in simulated environments before deployment, continuous monitoring of trading system performance for anomalies, and established procedures for immediate intervention and escalation when issues arise. This approach aligns with FINRA Rule 5320, prohibition on trading ahead of customer orders, and the general principles of fair dealing and best execution, ensuring that the firm's technological capabilities are used to benefit clients and maintain market order, rather than to exploit or disadvantage others. The focus is on preventing potential harm through robust controls. An incorrect approach that prioritizes speed and volume over system integrity would be to deploy new algorithmic trading strategies without thorough pre-deployment testing. This could lead to unintended consequences, such as excessive order submission or cancellation patterns that disrupt market liquidity or trigger erroneous trades, violating the principles of fair and orderly markets, and potentially leading to violations of rules against manipulative trading practices. Another incorrect approach would be to rely solely on automated alerts for system malfunctions, without a clear protocol for human oversight and intervention. This could result in delays in addressing critical issues, allowing potential market disruptions or client order execution failures to persist longer than necessary, thereby failing to uphold the duty of best execution and potentially exposing the firm to regulatory scrutiny. Finally, an incorrect approach that focuses on optimizing SOR routing solely based on the lowest execution fees, without considering market impact or the quality of execution at different venues, would also be professionally unacceptable. This could lead to suboptimal execution for client orders, failing to meet the best execution standard, which requires considering all relevant factors, not just cost. Professional reasoning in such situations requires a commitment to a culture of compliance and risk awareness. Traders and firms must prioritize understanding the capabilities and limitations of their trading technology, implementing robust testing and monitoring protocols, and maintaining clear lines of responsibility for system oversight and issue resolution. The decision-making process should always begin with an assessment of potential risks to market integrity and client interests, followed by the implementation of controls designed to mitigate those risks, even if it means slightly slower deployment or less aggressive optimization. Question 13. Examination of the data shows a client holds a significant long position in XYZ stock and has expressed a desire to protect against a potential decline in its price. The client specifically mentioned wanting to limit my losses if XYZ goes down. Based on this information, what is the most appropriate course of action for a Series 57 registered representative? Option A. Recommend purchasing call options on XYZ stock with a strike price significantly above the current market price. Option B. Execute a purchase of XYZ stock with a stop-loss order set at 10% below the current market price. Option C. Recommend purchasing put options on XYZ stock with a strike price close to the current market price and an expiration date that aligns with the client's risk horizon. Option D. Recommend selling a covered call strategy on the client's XYZ stock. The correct answer is C. Recommend purchasing put options on XYZ stock with a strike price close to the current market price and an expiration date that aligns with the client's risk horizon. Explanation. This scenario presents a professional challenge because a trader must interpret market signals and client intentions regarding options trading, a complex area governed by specific regulations designed to protect investors and ensure market integrity. The trader's responsibility extends beyond simply executing trades. It involves understanding the implications of different option strategies and ensuring they align with client suitability and regulatory requirements. Misinterpreting client needs or the implications of an option strategy could lead to significant financial losses for the client and potential regulatory violations for the firm. The correct approach involves recognizing that a client expressing interest in hedging a long stock position with a put option is seeking downside protection. This strategy aims to limit potential losses if the stock price declines. The trader's role is to facilitate this specific hedging objective by recommending the appropriate put option, considering factors like strike price and expiration date that best align with the client's risk tolerance and the duration of the hedge. This aligns with FINRA rules regarding suitability, which require firms and their associated persons to have a reasonable basis to believe a recommended transaction or investment strategy is suitable for a customer based on information obtained from the customer. An incorrect approach would be to recommend a call option strategy. This is fundamentally misaligned with the client's stated objective of hedging downside risk. Recommending a call option, which profits from an increase in the underlying asset's price, would expose the client to further losses if the stock price falls, directly contradicting the client's stated goal. This would violate the suitability rule by recommending a strategy that is not appropriate for the client's stated investment objective and risk profile. Another incorrect approach would be to suggest a complex option strategy, such as a straddle or strangle, without a clear understanding of the client's sophistication and objectives. While these strategies can be used for various purposes, they are generally more complex and carry different risk profiles than a simple put-option hedge. Recommending such strategies without a thorough suitability assessment and client understanding would be a failure to meet regulatory obligations, potentially exposing the client to undue risk and violating the principles of fair dealing. Finally, an incorrect approach would be to execute a put option trade without confirming the specific parameters, strike price, expiration with the client. While the client expressed interest in hedging with a put, the exact terms of the hedge are crucial. Executing a trade without this confirmation could result in a hedge that is not effective for the client's specific needs, leading to dissatisfaction and potential regulatory scrutiny for not adequately addressing the client's instructions. A professional decision-making process for similar situations should begin with a thorough understanding of the client's stated objective. In this case, the objective is clear: hedging downside risk. The trader must then identify the option strategy that directly addresses this objective. This involves matching the client's goal with the known characteristics of different option types and strategies. Regulatory requirements, particularly suitability, must be at the forefront of this decision-making process, ensuring that any recommendation or action taken is in the client's best interest and aligns with their financial situation and investment objectives. Question 14. Assessment of a securities trader's responsibility when observing a series of buy orders for a thinly traded stock appearing and disappearing rapidly just above the current bid price, followed by a large sell order that executes at a slightly lower price, creating a perception of downward price pressure. Option A. Continue trading as usual, assuming the activity is a result of normal market fluctuations and large institutional orders. Option B. Immediately report the observed trading pattern to the firm's compliance department for review. Option C. Attempt to contact the traders placing the buy orders to inquire about their intentions. Option D. Ignore the pattern as the individual trades are relatively small in size. The correct answer is B. Immediately report the observed trading pattern to the firm's compliance department for review. Explanation. This scenario presents a professional challenge because it requires a trader to distinguish between legitimate market activity and potentially manipulative behavior, demanding a keen understanding of market microstructure and regulatory intent. The pressure to execute trades quickly can sometimes obscure the need for careful observation and adherence to compliance protocols. The correct approach involves proactively identifying unusual trading patterns that deviate from historical norms or expected market behavior, and then escalating these observations to the firm's compliance department for further investigation. This aligns with FINRA Rule 5210, fraudulent and manipulative misrepresentations regarding securities, and the general principles of market surveillance mandated by the Securities Exchange Act of 1934 and its subsequent rules. Firms have a regulatory obligation to establish and maintain systems and procedures reasonably designed to prevent and detect manipulative trading. Escalating suspicious activity is a critical component of this obligation, ensuring that potential violations are reviewed by those with the authority and expertise to act. An incorrect approach would be to ignore the unusual trading activity, assuming it is simply a result of organic market forces or a large institutional order. This failure to monitor and escalate could lead to the firm being complicit in or failing to prevent market manipulation, violating the firm's duty of supervision, and potentially exposing the firm and its employees to regulatory sanctions. Another incorrect approach would be to attempt to personally investigate the suspicious activity by contacting the other traders involved or attempting to gather information independently. This bypasses the established compliance framework and could inadvertently tip off potential wrongdoers, hindering a formal investigation. It also places the individual trader in a position of potentially overstepping their authority and responsibilities, which could have ethical and regulatory implications. A further incorrect approach would be to dismiss the activity as insignificant due to the relatively small size of the trades, even if the pattern is unusual. Regulatory scrutiny is not solely based on the monetary value of individual trades, but also on the intent and effect of the trading pattern. A series of seemingly small, coordinated trades could still constitute market manipulation if designed to create a false impression of market activity or price. The professional decision-making process in such situations should involve a clear understanding of the firm's surveillance policies and procedures. Traders should be trained to recognize red flags for market manipulation, such as wash trading, matched orders, spoofing, or layering. When such red flags are observed, the immediate and correct action is to report the activity through the designated channels to the compliance department, allowing for a thorough and objective review. Question 15. Which approach would be most consistent with the principles of best execution for a customer order in a listed equity security, considering the various market structures available for trading? Option A. Routing the order to an internal crossing system that guarantees execution at the National Best Bid and Offer (NBBO) without actively evaluating other market centers for potential price improvement. Option B. Routing the order to the market center that provides the most favorable execution, considering price, size, and the likelihood of execution, by evaluating multiple venues including exchanges, electronic communication networks (ECN), and internal crossing systems. Option C. Routing the order to a market center that offers the highest rebate for order flow, regardless of the displayed price or liquidity. Option D. Routing the order to the exchange where the security is listed, assuming it offers the best displayed bid or offer at the time of order entry. The correct answer is D. Routing the order to the exchange where the security is listed, assuming it offers the best displayed bid or offer at the time of order entry. Explanation. This scenario presents a professional challenge for a securities trader because it requires understanding how different market structures impact the execution of trades and the potential for price improvement or disadvantage. A trader must be aware of the nuances of order routing and the implications of various trading venues to act in the best interest of their clients and adhere to regulatory obligations. Careful judgment is required to select the most advantageous execution strategy given the prevailing market conditions and the specific characteristics of the security being traded. The correct approach involves actively seeking the best execution for customer orders by considering multiple trading venues and their respective pricing and liquidity. This aligns with FINRA Best Execution Rule, Rule 5320, which mandates that member firms must seek to obtain the most favorable execution of customer orders, taking into account all relevant market center qualities. This includes considering price, size, and the likelihood of execution. A trader employing this approach demonstrates a commitment to fiduciary duty and regulatory compliance by prioritizing client interests over potential benefits from a single, less optimal venue. An incorrect approach that focuses solely on executing trades within a firm's own internal crossing system, without adequately considering external market centers, fails to meet the best execution obligation. This could lead to clients receiving inferior prices or experiencing delayed executions, potentially violating FINRA Rule 5320. Another incorrect approach, which prioritizes executing trades at a specific price point regardless of the liquidity or depth of the market at that price, ignores the broader market structure and the potential for better execution elsewhere. This can result in missed opportunities for price improvement or increased market impact. Finally, an approach that relies on a single, predetermined routing strategy without ongoing evaluation of market conditions and venue performance is also flawed, as it lacks the dynamic responsiveness required to consistently achieve best execution in a constantly evolving market. Professional reasoning in such situations requires a systematic evaluation of available trading venues, their characteristics, and the specific order being handled. Traders should continuously monitor market data, understand the order book dynamics of different venues, and have established protocols for order routing that prioritize best execution. This involves a proactive rather than reactive stance, ensuring that client orders are consistently handled with diligence and in accordance with regulatory requirements. Question 16. Implementation of a trading strategy for corporate bonds requires a trader to assess various risk factors. Which of the following approaches best aligns with regulatory requirements and professional due diligence when considering a significant purchase of a corporate bond for a client account? Option A. Executing the trade based on a positive tip received from another market participant without independent verification. Option B. Conducting a thorough credit analysis of the issuer, evaluating the bond's liquidity in the current market, and understanding its sensitivity to interest rate changes. Option C. Relying solely on the bond's historical price performance over the past 5 years to gauge its future stability. Option D. Prioritizing the bond's yield to maturity and its recent price appreciation to maximize immediate client returns. The correct answer is D. Prioritizing the bond's yield to maturity and its recent price appreciation to maximize immediate client returns. Explanation. This scenario presents a professional challenge because a trader must balance the need to execute trades efficiently with the regulatory obligation to assess and manage risk, particularly in the volatile corporate bond market. The pressure to achieve trading volume and profit can sometimes lead to overlooking critical risk assessment steps, which is a direct violation of FINRA rules governing fair dealing and due diligence. The correct approach involves a comprehensive risk assessment that considers the specific characteristics of the corporate bond being traded, including its credit quality, maturity, liquidity, and any embedded options. This proactive assessment is crucial for ensuring that the firm and its clients are not exposed to undue risk. FINRA Rule 2111, Suitability, and the general principles of fair dealing require that recommendations and transactions be suitable for the customer, which necessitates a thorough understanding of the securities risks. Furthermore, the firm's own risk management policies, often guided by SEC regulations and industry best practices, mandate such due diligence to prevent financial losses and maintain market integrity. An incorrect approach that prioritizes only the immediate profit potential without a thorough risk assessment fails to uphold the duty of care owed to clients in the firm. This oversight can lead to significant financial losses if the bond defaults or experiences a sharp price decline due to unforeseen market events or credit deterioration. Such a failure directly contravenes FINRA principles of fair and orderly markets and can result in disciplinary actions, fines, and reputational damage. Another incorrect approach, focusing solely on the historical price performance of a corporate bond without considering current market conditions or the issuer's financial health, is also professionally unacceptable. Past performance is not indicative of future results, and relying on it exclusively ignores the dynamic nature of credit risk and interest rate sensitivity inherent in debt securities. This demonstrates a lack of due diligence and a disregard for the potential for adverse price movements. A third incorrect approach, which involves executing trades based on rumors or tips without independent verification or analysis, is a clear violation of regulatory standards. Traders are expected to conduct their own research and due diligence, rather than acting on unsubstantiated information. This practice can lead to trading in illiquid or distressed securities without understanding the underlying risks, potentially harming clients and the firm. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This includes 1. Understanding the security, thoroughly researching the issuer, credit rating, maturity, coupon, and any special features. 2. Assessing market conditions, evaluating current interest rate environments, economic outlook, and sector-specific trends. 3. Evaluating liquidity, determining how easily the bond can be bought or sold without significantly impacting its price. 4. Considering client suitability, ensuring the trade aligns with the client's investment objectives, risk tolerance, and financial situation. 5. Adhering to firm policies, following internal risk management guidelines and compliance procedures. Question 17. The evaluation methodology shows that a securities trader is considering executing a short sale of a particular stock. The trader believes the stock is overvalued and wants to profit from a potential decline. Before initiating the trade, the trader must ensure compliance with short-selling regulations. Which of the following actions best demonstrates adherence to the locate requirement for short sales under FINRA rules? Option A. Executing the short sale immediately based on the trader's conviction about the stock's overvaluation, assuming shares will become available for borrowing shortly after the trade. Option B. Confirming that the shares intended for the short sale are readily available for borrowing from the firm's inventory or through a reliable third-party lending arrangement prior to executing the trade. Option C. Initiating the short sale and then attempting to locate shares for borrowing, relying on the expectation that the market will supply the necessary shares to cover the short position. Option D. Proceeding with the short sale after receiving a verbal assurance from another trader that shares might be available, without independent verification of their availability. The correct answer is B. Confirming that the shares intended for the short sale are readily available for borrowing from the firm's inventory or through a reliable third-party lending arrangement prior to executing the trade. Explanation: this scenario is professionally challenging because it requires a securities trader to navigate the intricacies of short selling regulations, specifically the locate requirement, while under pressure to execute a trade. Misinterpreting or neglecting these requirements can lead to significant regulatory violations, fines, and reputational damage. The core of the challenge lies in ensuring compliance with the locate rule, which mandates that a broker-dealer must have located the shares to be borrowed before executing a short sale. This prevents market manipulation and ensures the availability of shares for delivery. The correct approach involves a thorough understanding and strict adherence to the locate requirement as defined by FINRA rules. This means confirming that the shares intended for short sale are readily available for borrowing, either from the firm's own inventory, from another broker-dealer, or through a guaranteed loan. This proactive verification is crucial for lawful short selling. An incorrect approach would be to execute the short sale without first confirming the availability of shares. This bypasses the locate requirement, which is a direct violation of FINRA Rule 5130, or its successor rules governing short sales. Another incorrect approach is to assume shares are available without independent verification, relying on past practices or informal assurances. This demonstrates a lack of due diligence and a failure to comply with the explicit regulatory mandate. A further incorrect approach is to proceed with the short sale based on a belief that the market will naturally provide the shares, ignoring the pre-trade locate obligation. This demonstrates a misunderstanding of the purpose of the locate rule, which is to ensure orderly markets and prevent failures to deliver. Professionals should approach such situations by prioritizing regulatory compliance. This involves a systematic process. First, understanding the specific short selling regulations applicable, in this case, FINRA rules. Second, confirming the locate requirement is met before executing the trade. And third, documenting the locate process. If there is any doubt about the availability of shares or the interpretation of the rule, the trader should consult with their compliance department or supervisor before proceeding. Question 18. During the evaluation of a potential foreign exchange trade involving the EUR/USD currency pair, a trader observes that the current market bid price is 1,050 and the ask price is 1,052. The trader wishes to purchase euros. Which of the following best describes the trader's action to execute this trade in compliance with regulatory expectations for securities traders? Option A. Execute the purchase of euros at the ask price of 1,052, as this is the price at which the trader can buy the base currency EUR from the market maker. Option B. Execute the purchase of euros at a price between 1,050 and 1,052, as this represents a fair market value. Option C. Execute the purchase of euros at the bid price of 1,050, as this is the price at which the trader can sell the base currency EUR to the market maker. Option D. Execute the purchase of euros at a price that is slightly lower than the bid price to secure a better deal for the client. The correct answer is A. Execute the purchase of euros at the ask price of 1,052, as this is the price at which the trader can buy the base currency EUR from the market maker. Explanation: this scenario is professionally challenging because it requires a trader to navigate the complexities of foreign exchange trading while adhering to strict regulatory requirements designed to protect investors and maintain market integrity. The core challenge lies in understanding the mechanics of forex trading, including the pricing of currency pairs and the execution of trades, within the framework of FINRA rules applicable to the Series 57 exam. A key aspect is recognizing that forex trading, while often conducted over-the-counter (OC), is subject to regulations concerning fair dealing, best execution, and the prevention of manipulative practices. The correct approach involves accurately identifying the bid and ask prices for a currency pair and understanding how these prices reflect the market's current valuation. A trader must then execute the order at the best available price, considering the prevailing exchange rate and any associated transaction costs. This aligns with FINRA emphasis on fair and orderly markets and the obligation to deal fairly with customers. Specifically, the Series 57 exam tests understanding of how market participants interact and how prices are formed in various trading environments, including forex. executing a trade based on the current, publicly available bid and ask prices, and understanding that these prices represent the immediate buying and selling opportunities, is fundamental to compliant forex trading. An incorrect approach would be to execute a trade based on a price that is not readily available or is demonstrably outside the prevailing market bid and ask. For instance, attempting to execute a trade at a price that is significantly different from the current market quote, without a clear and justifiable reason, such as a large block trade requiring special execution, would raise concerns about fair dealing and potentially manipulative practices. Another incorrect approach would be to misunderstand the relationship between the base and quote currency in a pair, leading to an incorrect assumption about the direction of the exchange rate or the value of the transaction. This demonstrates a lack of fundamental understanding of forex mechanics, which is a core competency tested by the Series 57. Furthermore, failing to consider the best available execution price, perhaps by executing at a less favorable rate due to inattention or misunderstanding, would violate the duty to obtain the best reasonably available price for the customer. Professional decision-making in such situations requires a thorough understanding of the trading instrument, the prevailing market conditions, and the applicable regulatory obligations. Traders must always prioritize fair execution, transparency, and adherence to established market practices. This involves continuously monitoring market prices, understanding the implications of different order types, and ensuring that all transactions are executed at prices that are consistent with the best available market quotes. Question 19. Stakeholder feedback indicates that traders are sometimes struggling to adapt their execution strategies effectively when transitioning between periods of high volatility and low liquidity, and periods of stable markets with high liquidity. A trader is presented with an opportunity to execute a large block trade in a security that is currently experiencing significant price swings and has a limited number of buyers and sellers. What is the most appropriate approach for the trader to consider in this market environment? Option A. Focus solely on capturing short-term price movements within the volatile environment, disregarding the overall liquidity of the market. Option B. Halt all trading activity for this security until market conditions stabilize and liquidity improves. Option C. Execute the entire block order immediately to secure the best possible price before the market moves further. Option D. Break down the large order into smaller, manageable portions and execute them strategically over time, using limit orders to control price while closely monitoring market conditions. The correct answer is C. Execute the entire block order immediately to secure the best possible price before the market moves further. Explanation. This scenario is professionally challenging because it requires a trader to adapt their strategy based on dynamic market conditions, specifically the interplay of volatility and liquidity, while adhering to regulatory obligations. The trader must balance the need for profitable execution with the duty to avoid manipulative practices and ensure fair dealing. Careful judgment is required to distinguish between legitimate trading strategies and those that could be construed as market manipulation or detrimental to market integrity. The correct approach involves recognizing that in a volatile market with low liquidity, the risk of adverse price movements and the potential for significant slippage are heightened. A trader employing a strategy that prioritizes minimizing market impact and securing a favorable execution price, such as breaking down large orders or using limit orders strategically, demonstrates a commitment to responsible trading. This approach aligns with FINRA rules that prohibit manipulative or deceptive practices and emphasize fair and orderly markets. By seeking to execute trades without unduly influencing prices, the trader upholds their duty to their firm and their clients and contributes to market stability. An incorrect approach that involves aggressively executing large orders in a volatile, illiquid market without regard for price impact risks exacerbating price swings. This could be seen as a manipulative practice under FINRA rules, as it could artificially influence the price of a security. Such actions can lead to significant losses for the trader or their clients due to slippage and can be detrimental to overall market fairness. Another incorrect approach, which is to cease trading altogether in such conditions, might be overly cautious and could lead to missed opportunities. While risk management is crucial, a complete cessation of trading might not be the most effective strategy if there are legitimate trading interests to be met. The challenge lies in finding a balance, not in complete avoidance. A further incorrect approach, such as solely focusing on short-term price fluctuations without considering the broader market environment and liquidity, can lead to poor execution and increased risk. This approach neglects the fundamental principles of responsible trading in different market conditions and could result in trades that are not in the best interest of the client or the firm. A professional decision-making process for similar situations should involve a continuous assessment of market conditions, including volatility and liquidity. Traders should have predefined strategies for different market environments and be prepared to adjust their execution methods accordingly. This includes understanding the potential impact of their orders on the market and prioritizing fair and orderly execution over simply achieving a trade at any cost. Adherence to FINRA rules regarding manipulative practices and best execution is paramount. Question 20. Performance analysis shows that a securities trader, acting as a principal for a customer's order, has executed a trade where the firm purchased a security at $10.00 and sold it to the customer at $10.25. The firm also incurred a $0.05 per share exchange fee and a $0.01 per share regulatory fee. The prevailing bid-ask spread for this security at the time of the trade was $0.10. The trader is reviewing the transaction to ensure compliance with fair pricing regulations. Which of the following best reflects the trader's responsibility regarding the pricing of this transaction? Option A. The trader can add the $0.05 exchange fee and $0.01 regulatory fee directly to the $0.10 spread, and this total amount is automatically considered a fair markup. Option B. The trader is only responsible for ensuring the commission charged to the customer is fair, as markups and markdowns are implicitly covered by the spread. Option C. The trader must ensure that the $0.25 difference between the firm's purchase price and the customer's sale price, combined with the $0.06 in fees, represents a fair and reasonable markup considering the prevailing market spread and the services provided by the firm. Option D. The trader should focus solely on the $0.10 prevailing bid-ask spread as the primary determinant of fair pricing, as this represents the market's inherent cost. The correct answer is C. The trader must ensure that the $0.25 difference between the firm's purchase price and the customer's sale price, combined with the $0.06 in fees, represents a fair and reasonable markup considering the prevailing market spread and the services provided by the firm. Explanation. This scenario is professionally challenging because it requires a trader to balance the firm's profitability with fair dealing to customers. Core principle under FINRA regulations. The trader must understand how various trading costs impact the final price and ensure that any markups or markdowns are reasonable and justifiable, especially when acting as a principal. The Series 57 exam emphasizes the trader's responsibility in these transactions. The correct approach involves accurately identifying and disclosing all relevant trading costs to the customer, particularly when the firm is acting as a principal, and charging a markup or markdown. This includes understanding that exchange fees and regulatory fees are passed through and are part of the overall cost of the transaction. The firm must ensure that markups and markdowns are fair and reasonable, considering factors such as the spread, the size of the transaction, and the services provided. FINRA Rule 2121, Fair Prices and Commissions in All Transactions, and the interpretation of the Securities Exchange Act of 1934, particularly Section 15C, govern these practices. Transparency regarding all costs, including commissions, markups, markdowns, and fees, is paramount to avoid misleading customers and to comply with fair dealing obligations. An incorrect approach would be to only consider the commission and the spread when determining the final price, ignoring exchange and regulatory fees. This fails to account for all direct costs associated with the trade, potentially leading to an unfair price for the customer and a misrepresentation of the total cost. Another incorrect approach would be to absorb some of the exchange and regulatory fees without adjusting the markup or markdown accordingly, which could lead to the firm taking a loss on the transaction or not charging a fair price for its principal role. A third incorrect approach would be to pass on all fees and add a significant markup without considering the prevailing market price or the services rendered, which would violate the principle of fair and reasonable pricing. Professionals should approach such situations by first understanding the nature of the transaction, agency vs. principal. When acting as a principal, they must meticulously itemize all costs, including commissions, if applicable to the client's account structure, the bid-ask spread, any exchange or regulatory fees, and then determine a fair and reasonable markup or markdown. This involves consulting firm policies, market data, and FINRA guidance on reasonable markups and markdowns. The key is transparency and fairness to the customer, ensuring they understand the total cost of the transaction, and that the firm's profit is derived from a reasonable spread or markup, not from hidden or excessive charges.